Hello, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and a finance presenter, columnist and podcaster for the ABC.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Well, James, it's before 8 on Wednesday morning, and no doubt you've been bashing something out about what happened on Wall Street last night. Tell us what you wrote.
Alan, yes, I've been watching this closely and just filing on it. And I think that the story here is that it's all started with a Korean barbecue. I don't know if you spend a lot of time watching the Korean market, but it had a bad night on...
Quite like a Korean barbecue, though.
Had a bad day on Tuesday. The market fell 10%. It's called the Kospi Index. And this year it's been powered by two stocks, basically SK Hynix and Samsung Electronics, both of which make memory, computer memory, which has become increasingly important in the AI infrastructure build-out. You need lots of memory to help make those data centers. But yesterday we saw, on Monday night we saw a bit of skittishness in tech stocks on Wall Street. The big move there was SpaceX was down 16%. That carried over into the Korean session on Tuesday. But two things happened. One thing is that SK Hynix said that they will adjust their production. They'll make less of their AI memory chips and more commodity memory chips, they're called. That's the stuff that goes into your laptop and other devices. And while this was portrayed as a move because the commodity memory profit margins are bigger than the AI profit margins, so SK Hynix is sort of, making sure it maximizes
That's
profits.
A bit surprising.
Yeah, a little bit. But we have seen in the last little while a bit of a push around... we've seen laptop memory prices shoot up. I don't know if you've noticed that, but...
it's been a while since I bought a laptop.
Yeah, if you went and bought one now, you probably end up paying the same, let's say you wanted to spend, I don't know, I'm picking a number here, $1,500 on a new laptop. You'd still be able to find a $1,500 laptop. It would just have less memory and less compute in it than it did a year ago. Because of these soaring memory costs. There's a shortage of memory around the world. So anyway, SK Hynix made this announcement. People read it as, is AI demand shrinking? And that pushed, that weighed heavily on these stocks. But the other problem in Korea, Alan, is that they've become very enamored with these ETFs that allow you to bet on a single stock using leverage. So
that's not just in Korea, is it?
No, it's not just in Korea. It's in America and Hong Kong. The most popular ones are in Hong Kong, actually. And the most popular of these levered ETFs is the most popular levered ETF in the world, allows you to bet on the share price movement, the daily share price movement on SK Hynix with 2 times leverage. So let's say SK Hynix goes up or down 5% in a day, then this ETF goes up or down 10% in the day. Right. And the Asian investors have fallen in love with these things and are juicing their bets on the AI trade in with extra leverage. Now that's great when the stocks are going up, which they have been, but at moments of doubt, you get these moments of big volatility. And so yesterday we saw the Korean market briefly shut because it hit its, it fell as much as the operators are allowed to allow it to fall in any one session. That's the 4th time that's happened in the last year. And we saw SK Hynix and Samsung close down more than 12%. That rolled over into Wall Street. So the Philadelphia Semiconductor Index, the SOX Index, which has been the hottest trade in the world this year, it was down 8% last night. NVIDIA was off 4%. A company called Micron Technologies, which is probably the hottest memory stock in the world other than the hottest chip maker in the world, it was down 13%. So we've seen this real sell-off in chips and chip stocks and memory stocks. It's already got a little name, the Chipwreck.
The Chipwreck. That's nice.
And I guess the question is, well, there's two questions for me. One is that these chip stocks have become the new leaders on Wall Street. You know, the hyperscalers like Amazon and Microsoft and Alphabet, they've had a tougher run this year. I was just looking at Microsoft's share price. It's down 20% since the start of the year, as a little example. And what we've seen is these chip stocks really take market leadership. So the question is, if these chip stocks start to go, does the market as a whole roll over? And of course, you know, this is not happening in a vacuum. We've got extraordinary amounts of debt being issued by the AI sector. We've got extraordinary amounts of government debt being issued. We've got interest rates now pushing higher and bond yields pushing higher around the world. It's a pretty fragile time, I think, Alan. But you know, I can be a bit bearish. I acknowledge that, and I always think there's a bit of fragility. But you know, we've ridden this chip story pretty hard this year, and maybe it's due a breather.
Yes, SpaceX I noticed was up last night. Not much, one and a bit percent, having fallen by 30% since from the peak. So as I pointed out last night on the news, it's down about $1 trillion Australian dollars in just a few days. Unbelievable.
Yeah. Oh, amazing.
And I've also been reading about one of these leveraged ETFs about SpaceX. So
yeah.
it's as with SK Hynix, there's a 2 times ETF in SpaceX that's available as well, and people are piling into that. I think more people
yes.
are buying that than actual SpaceX shares. It's amazing.
It's pretty wild, isn't it? And I think, I mean, that is maybe that's the big lesson here. Like, the world is not positioned for much volatility. You know, we're all global fund managers piled into this AI trade. All the indices around the world are you know, highly exposed to this AI trade. We're just not positioned for much to go wrong.
Yeah,
and right. We're just starting to get a few little cracks in the story, I think.
I was reminded by the death of Alan Greenspan the other day at the age of 100 that he, when he was chairman of the Fed, called out the US stock market as being irrationally exuberant in 1996.
Yes.
You know, and famously said, and the market was gone too far, it was terrible, it was irrationally exuberant. And of course, the thing didn't crack until another 4 years. And it more than doubled in the meantime. So anyone who sold out when he said it was irrationally exuberant definitely missed out.
And I think that you know, that's the other danger here, isn't it? That investors do become too bearish, and you know, there's no being bearish in the last 5 years has been, you know, pretty costly. Let's be honest.
That's right.
But the Greenspan example is a good one. You know, these bubbles run longer than you can think. Run longer than you think they will, but when they pop, they tend to be pretty disastrous. You know, the Nasdaq was down 80% over the following 3 years after the .com bubble popped. So
yeah,
we are, and I would just say that the world is even more leveraged. You know, you keep thinking about different asset classes in the world. Private credit, private equity, venture capital, infrastructure, they've all become to a greater or lesser extent a bet on AI at the moment, because so much money, debt, venture capital investment is going to AI related stuff. So we better hope this holds.
Yeah, well, so just on that subject, your colleague on Chanticleer, Anthony McDonald, had a nice piece the other day about what active fund managers in Australia are doing. So just sum it up for us. What are they doing?
Well, they're not doing what you'd think they do. I mean, Australia is, you know, we call it a barbell market. At one end of the barbell, there's banks. The other end of the barbell, there's miners. active fund managers are not are underweight those two barbells, and they're looking for value in places like healthcare. CSL is still a really big holding, and looking for value in cyclicals. They're underweight the banks, and they're underweight BHP.
CSL's getting better value every day.
Yes, indeed. So it is a bit surprising, but this is the tough thing for stock pickers. So much money is now, because of index investing and the way the super industry invests in Australia, which is, that they have no choice but to hug the index because of this performance test, which means that if you aren't close to the index, you're going to get named and shamed by the government. So much of the capital in Australia is flowing to the 10 biggest stocks. But if you're if you're a sort of traditional stock picker who looks at the banks and thinks, gosh, they're expensive, your training, your approach, your mandate, it doesn't really, you need to be underweight those stocks because they're too expensive.
But the ETFs are driving them up.
Exactly. So there's this sort of vicious cycle, and then what happens is that the active managers underperform, and then the super funds that still do have some money with those active managers, they look at their performance and say, "Hang on, I this isn't in my members' best interests." So it's a sort of vicious cycle going on for stock pickers at the moment. They're trying to beat an index that is, sort of unbeatable in a way.
No, I know. I think it's, and as you say, I mean, it just keeps getting worse for them because they underperform the ETFs. Everyone looks at their performance versus the ETFs and takes their money out of the active managers, puts it into the ETFs, and that extra money in the ETF means that they have to go and buy Commonwealth Bank and BHP and Westpac and them, and that drives those prices up even further, and the ETFs further outperform the active managers.
Yeah. Yeah.
So it's a sort of, as you say, it's a vicious cycle.
Yeah. So look, it's a really interesting time in markets at the moment. At an index level, everything looks pretty good. We sort of keep grinding higher, but I think there's some really interesting stories under the hood.
Speaking of interesting stories, let's talk about KPMG. Now, you were very tough on them this morning.
Was I?
Well, no, not too tough. I mean, you said that
no. Look, I'm happy to be tough.
The rescue plan shows that they're still on another planet.
Look, this isn't just KPMG. I mean, this is the sort of weird world that we've allowed to build up. KPMG, for those who sort of come late to this story, they're engulfed in a scandal that's emanated from their audit business, and what happened is that the audit partners, or some audit partners in KPMG, took a gander at some confidential documents. In sort of the most celebrated case, the confidential documents of a company called Lendlease, a listed company, and they had a look at these at Lendlease's confidential documents, and then tried to use some of the information that they'd learnt from that to go and win other audit business at places like Dexus and Westpac. No confidential information was shared from client to client, so that's good, but clearly it's a breach of ethical standards. You shouldn't be looking and sharing confidential client information. This is all blown up, become a big issue. There's a big parliamentary inquiry going on into this. We've seen the CEO of KPMG and now depart, and now the chairman, Martin Shepherd, has resigned as well. KPMG's got a 3-month freeze on government work. It's another one of these messes in professional services not so long after the big scandal at PwC. What I was struck by, Alan, was that KPMG announced this big sort of action plan to fix themselves up, and the big sort of headline was that that KPMG now plans to adopt best corporate governance practice from the corporate sector, and that means that they're going to have an independent chair and more independent directors. And to me, that just shows that these firms have been, I said, living on another planet. An independent chair and independent directors, that's standard. That's minimum minimum expectations for any ASX
That's right. And you say,
company.
sorry, that wasn't happening already?
Exactly.
What a joke.
I mean, it's unbelievable that, that.
Yeah, but James, it's inherent in the partnership structure. So I mean,
Of course,
the way
yeah.
the difference between a company and a partnership is that in a company, the ownership and the management is separated. There are separate owners, and in most companies anyway. I mean, obviously, in a lot of companies, some companies, managers are big owners,
Yeah.
particularly with the proprietor that manages the business as CEO. But with partnerships, the owners are the managers. And there's no doubt about it. In order to become a partner, you have to show that you're able to engage in good business development, as they call it, which is finding new clients. And so the whole incentive structure in a partnership is that the people who rise to the top are those who are able to sign up new clients. And so the partners, the main job of partners, in fact, is not to actually conduct the audit or to do the actual advising, but to basically get new business, new clients. And so, I think there's an inherent problem with having these businesses as partnerships.
Yeah, absolutely.
I mean, I just think there needs to be a rethink of how this is organised, and I'm not whether you actually ban them from being partnerships and say no, you've got to be a company at a certain level or whatever. I don't know. I mean, maybe there's a way to regulate them.
Well, there's been lots of suggestions. I mean, we've had suggestions such as limiting the number of partners that can be in a partnership. So, at these big firms, you might have 400 or 500 partners. I mean, that's just, should we be limiting it to 40 or 50? And then these large businesses that are advising our largest companies, and that we should expect to have not just be suddenly moving towards best corporate governance practice now. I mean, should they be forced to corporatise in some way?
Do you think that the audit function should be separated from the professional services functions?
Possibly. I mean, yes, I think that's been suggested and looked at. I think I think the Chinese walls can be kept in place. Well, yeah, perhaps I should say I thought that could happen, but we keep seeing these ethical breaches. I mean, as the Green Senator Barbara Pocock was saying last week that there was a parliamentary hearing on all this on Friday, she kept saying, we've now got two of the big four, half of the big four have stuffed up. Like, when does enough become enough?
Yeah.
So this is a mess for KPMG, and it's remarkable to me that KPMG and Deloitte and EY, all of which don't have independent chairs as a starting point at the moment, they all watched PwC go through this trial by fire a few years ago, and they sat there and didn't think, I wonder if an independent chair might be a prudent move.
Yeah.
People are dumb. Organisations can be dumb.
So just before we move to questions, what do you reckon about the capital gains tax horse trading now? Because, I mean, it's interesting. The Greens have obviously got balance of power in the Senate, and they're using that now to try to prevent the cutbacks to the NDIS in return for passing the capital gains tax legislation. So what they've succeeded in doing is getting the NDIS legislation put back for a while. I think it's 2 months or something.
Yeah.
So everyone can talk about it some more. But they've clearly said that they want to stop it, which is interesting. I mean, they've managed to get up a ban on self-managed super funds borrowing money to buy residential property, which blindsided everyone. I mean, my SMSF has never borrowed to buy a residential property, but obviously some people's do.
Yeah, absolutely. And I mean, I think the government's sort of given ground on this based on the idea that, quite clearly, Labor is committed to changing the tilting the scales in the property sector away from property investors, so that they've been willing to make this sacrifice around SMSFs. So the NDIS one is interesting. I mean, even Labor, the sort of even the architects of this scheme concede that it's, it needs to be better managed so it delivers the best bang for the taxpayers' buck and for the participants in the scheme. The less wastage there is, the better results we should get for the participants in the scheme who clearly need its support. So quite what. Yeah, I've listened to a bit of the Greens' positioning on that. They just seem to be sort of saying, well, no cuts are warranted because we worry that any money being taken away from anyone is bad. But
yeah,
I mean it's a bit of a.
It does seem to me like the Greens just want to win.
Yeah. Yeah, it's a very sort of oppositional position, isn't it? It's a position you can take when you don't have to balance the budget, which the Greens will never have to do.
That's right.
And to your point, Alan, you do wonder if there's a bit of a sense here that the Greens can see One Nation having some wins that they'd like to get back to winning too, I guess.
Someone wrote this morning, I can't remember who it was, saying that just wait till One Nation gets the balance of power in the Senate. See what happens then.
Yeah, well, I mean, I think it's interesting. There's obviously a lot more focus on the One Nation's policy platform. Some of it's detailed, a lot of it's sort of ideas without costings or much real thought to how the ideas might work. But we're all going to have to come to grips with it more. That's for
Definitely.
sure.
Before we get to questions, just a quick general advice warning. This is general advice only, not personal advice. So please, if you want specific advice, please see an advisor or an accountant or someone. Now, we've got a few questions about they're more statements, aren't they, about first home super saver scheme, telling us that there is one. There is a super saver scheme. We got it, everyone.
Yep. And this goes back to that idea of there being a sort of tax-free account, as we've seen in Canada and the UK. We had Luke, Joe from Brisbane, and Hugh telling us that there is that house saving scheme inside super that does exist.
But it's not tax-free. It's 15%, obviously.
Yeah.
Which is okay. Is there a limit on it? I can't remember. I think there is. Up to 50K.
50K, yeah. So... there are some limitations, but yes, it is there, and it does seem to be something that people should have a look at, if nothing else, Alan.
You can take the childcare ones.
Okay,
summarise them.
We've got some three childcare questions from Natalie, Daddy C, and Tom. And I think, Alan, the point here is that basically the childcare, I don't know how else to say this, the childcare system complex is basically broken. And what we're seeing from our listeners is that the costs are so expensive that they are having to make pretty big choices around how much they work, when they trip over thresholds, how they get the balance right between income and the costs of childcare and their career. I don't know. Is that the best way to summarise it?
Yeah, sure. I totally agree that the childcare system in Australia is broken. My suggestion a couple of times now, and the more I think about it, the more I'm convinced of this, is that it ought to be nationalised. I think the government's got to take it over and make it free, essentially.
Yeah.
I mean, it'll be expensive, but I think it's a good thing. I've actually today recording a piece for Sunday for the ABC News on working from home, and just as a part of that, I've found that the biggest increase, which doesn't surprise me, the biggest increase in working from home is among women with children under 4. so that they can basically deal with childcare at the same time. Now, obviously, trying to work with a 3-year-old in the house is impossible, but I think the idea is, and what's going on, is that people are able to pick the kids up or deal with them when they're sick or something.
Yeah.
If they're working from home or able to work from home, that they wouldn't otherwise be able to do. And I do think that the whole system is a mess, really.
So just to go through some of the suggestions from the listeners, Natalie is heavily in favour of making childcare tax deductible.
Yep.
Since 2021, her and her partner have spent $135K after tax on childcare for 2 kids.
That's after tax, that money.
After tax. Amazing. Daddy C says would like us to take a leaf out of the playbook of Germany, where they get unlimited childcare for €50 a week.
Yeah, I wonder who. I mean, I don't know this, but I wonder who owns it in Germany, whether it's private or government.
Yeah, good question. Not sure. And Tom actually takes makes the good point that should we be income splitting? So Tom's the main financial provider for his family. Excellent wages. It puts him in the top 7% of income. However, my wife only works 2 days a week part-time. Her small wage drops our household income to the 75th percentile, which is still great, but we get smashed with a diminishing childcare rebate as it's calculated on household income rather than the individual. So is there some sort of income splitting, which One Nation has pushed for in other areas? So
right.
Yeah.
All good suggestions.
And Alan, you've got to say, this is from what we've seen on the show in the last couple of weeks, this is fertile ground. This is fertile political ground, isn't it?
Oh, yeah, absolutely.
Yeah.
I mean, so many people are struggling with childcare.
Yeah.
That if the government could come up with a decent solution, it would be very popular.
Yeah. Let's jump into some property questions. Your turn, I think.
Michael says, do you know why residential property appears to be one of the few asset classes where the seller has the right not to name a price? I'm currently attempting to buy an investment property in Queensland, and a significant proportion of properties have no price listed. It creates a lot of time wasting for both parties, and it seems inefficient. I agree.
I agree, but I think there's lots of asset classes where the seller doesn't have to name a price. If you're selling a business, for example, you don't have to say, this business is worth $500 million.
No, you're right.
You might have a lot of parties. If you're selling a pipeline, you would do the same. So,
and if you're selling a painting at the Sotheby's auction, they just say, here it is, what do you bid? What's my bid? And they kind of say, can we start at $1,000 or something?
Yeah. So I take Michael's point on inefficiency, but I don't think property is the only one here.
Well, that's particularly the case since it's auctioned. I mean, it's true that the share market is basically a continuous auction and people do name their sell price, but the thing is that the sell and buy prices are all kind of continuously quoted.
Yeah.
So it is a different setup.
Totally. Yeah. Good point. Ross says, this is one for you, Alan. A little while ago, you told an anecdote about Kevin 15 and Kevin 50, which you might have to explain for us. Who was right out of Kevin 15 and Kevin 50, or were they both right and we're stuck in a no man's land with a population between the two, resulting in or exacerbating a productivity lag, housing crisis, etc., etc.?
Well, it was an anecdote told by Ken Henry, who was the head of the Treasury Secretary at the time, and he had a meeting with Kevin Rudd, who was Prime Minister, and Kevin Rudd said, "What do you think the optimum level of population in Australia is, Ken?" And Ken said, "I think it's 15 million." And Kevin said, "You're absolutely right, 50 million for sure. I reckon that's true, 50 million," because he misheard him, right? And he thought 50. And Ken said, no, 15, 15, Prime Minister. That's what I think. And at that time, the population of Australia was 22 million. And so it just kind of goes to show the difference between the political big Australia idea and the more conservative Treasury economist idea of smaller government. A smaller population. I think Ken basically still thinks that it should be smaller than it currently is, but of course now it's 28 million, not 22. and apparently still heading towards 50 million.
That horse has bolted.
So, yeah, I mean, and he's stuck in a no man's land with population between the two, perhaps resulting in exacerbating a productivity lag housing crisis. Yeah, I'm not sure about productivity, but certainly housing is not. I think that what's interesting at the moment is that immigration is becoming a kind of obviously political hot potato with One Nation, and then the coalition chasing One Nation with lower immigration targets. The Treasury forecast for immigration for next year is 225,000. This year it's going to be 300,000. So Treasury is forecasting a pretty significant decline in immigration over the next 12 months. Now, they're always wrong, so that doesn't mean it's going to happen. But I've got a feeling, I reckon what will happen is, and I don't know this, that the government will actually turn that 225,000 into a target and say, not only are we predicting that, we're going to achieve it.
Yeah, okay.
And I think if they do that and in fact achieve it before the next election, then that could leave One Nation and the coalition high and dry on this subject.
Yeah, okay. Interesting prediction. Julie says, I believe that the Australian Chamber of Commerce and Industry recently commented that housing is a passive investment while shares are a risk investment. This comment has me wondering, in the past, with the negative gearing and the Liberal government attitude that house prices should not fall, that is, house prices were a sign of economic success, was this passive versus risk revelation ever revealed by the ACCI in the past? Now Labor seems to give equal treatment to housing and share investments. Do you foresee Labor supporting house prices if they do fall? The government removing the risk that house prices will fall is the moral hazard that caused the housing crisis in the first place. Will Labor give equal support to shares if they fall in value? If houses can't fall in value, they should not be treated as an investment.
Well, this question's doing a lot of work, James. A lot in this. I don't think the ACCC has ever called housing a risk
the Chamber
investment.
of Commerce and Industry, and Andrew Irvine, the chief executive of NAB, has used that delineation too.
Yes.
Yeah.
And the people in business, like the Chamber of Commerce, they've always said this. But the question is, do we foresee, I mean, I think the relevant question here is, do we foresee Labor supporting house prices if they do fall? No, I don't. No. I mean, what are they going to do? I mean, we're clearly heading for a fall in house prices, right?
Absolutely.
Question is whether it's more than usual. The average. So I had a graph on the news the other night showing that there have been 8 house price falls since 1980. Yep. The average is 5%. The average time of them is 14 months. The biggest was 7.5% in 1982. So the early one was 7.5%. That was the biggest. So house prices have never fallen by more than 7.5%. The other big ones were 7%. So I don't know. I mean, some people saying, it'll be 10% for sure, which would make it the biggest fall. But there's nothing the government's going to do about that if it happens.
Well, this is a deliberate policy platform too, right?
Actually, it's interesting because the policy platform is to make housing more affordable,
yes,
not to make house prices fall.
Yeah,
and in fact, the government and the Claire O'Neill, the housing minister, is explicitly saying, no, we don't want house prices to fall. We just want them to rise sustainably. Yes.
Yes. No.
Well, that's because most voters own a house. The last thing they want is for the government to be talking about house prices falling.
Yeah, fair enough. Good point. I guess I mean they're clearly tilting that. They're clearly taking the investor. They're clearly trying to reduce the investor's role in housing.
Yeah, that's right.
And that's going to have the same impact.
Well, it'll be interesting to see what that does to rents, I suppose.
Yeah, very true.
Which it probably will lead to a bit of a skewing of housing towards ownership and away from rental because rents will go up.
Yeah.
Yeah.
Well, if it doesn't, Labor's got a real problem.
Yeah. We've got so many questions. Do you think we should jump forward a bit?
Yeah, sure. I'm in your hands.
Jeff says, this may sound naive, but what happens when a company like SpaceX that floats to $1 trillion valuation but potentially never returns a profit? Do investors slowly sell out? Do the more informed, larger investors get out first, leaving mum and dad superannuation funds left holding the bag, or are they too big to fail? The whole price to earnings is irrational. How long can shareholders hold? I think that's interesting.
Well, it is interesting, but they can hold for a very long time. I mean, the great example, Jeff, is Amazon. I mean, Amazon was unprofitable for, the best part of a couple of decades. But they could show to investors why they were unprofitable. That if they'd only had their books business or their retail business, they could have turned a profit, but they were using that profits generated from the book business to invest in their cloud business. And it turned out to be exactly the right strategy. Now Amazon's fabulously profitable.
Yeah.
So this can hold for a while. Tesla's a similar example. It was unprofitable for a very long time before it edged into profitability. But again, it's investing huge amounts of money. So this can go for a long time. The question is whether investors continue to believe the story and believe that profit moment will come eventually. And that's going to be the tough thing for Elon. But, no one on the planet spins a better financial story than Elon. He's the master of it.
I saw a graph last night that divided the Russell 2000, which is the big index of the US stock market, obviously 2,000 stocks, divides it into companies that make a profit and companies that don't make a profit. And the companies that don't make a profit outperform the ones that do make a profit.
Yep.
Which I thought that was amazing.
Well, it gets back to Mr. Greenspan and his exuberance question. Is that irrational or is it rational? Given that that the profits from AI are still to come, they're still before us. I don't know. I every day I go back and forth between AI is going to work and AI is not going to work. It's so hard to make a call right at the minute.
It is.
Sophie says, I recently saw this article about Transgrid trying to recoup billions of dollars in losses from customers because a project ran over budget. This seems completely absurd to me and puts more strikes in the column of all this privatisation being neoliberal bupkis. It's great in theory but doesn't work in practice. If they made a profit, that profit certainly wouldn't have to be passed on to consumers, so why should the loss be?
Always good to socialise your losses, isn't it? So what's the question?
Yeah, well, should all these natural monopolies be renationalised as they clearly aren't being run more efficiently by the private sector, and the taxpayer has to pay for the energy regulator anyway? What can we, as humble citizens or journalists with a lot of influence, do about this absurdity/scam?
Renationalised, yep. Well, as you know, I'm in favour of nationalising the childcare industry, but I don't know about nationalising anything else.
Yeah, it's an interesting question, Sophie. And look, this is an isolated example. It's about a power line that Transgrid, went over budget over time, but this is sort of what happens in the real world, I guess. I mean, let's play Sophie's scenario through. If Transgrid was renationalised and owned by the state again, like those losses would have to be copped by someone, wouldn't they? They'd be copped by the taxpayer.
Yeah, that's right.
So either way, Sophie, perhaps it's better that the customers using that power line pay rather than all of us. That's possibly one argument. I'm not. Yeah. That'd be my question. I mean, I take your point about profits don't get shared by or passed on to consumers. So why should losses be? But I guess you're right. If you renationalised it, you take the risk of profits and losses being shared by borne by the taxpayers. So maybe that is a model people would prefer, but
it's not going to happen. So.
I think the horse is bolted there.
I like Sylvia's question, which I'll read out, but I'm not quite sure there's much to it, but Sylvia says, my husband and I perform around South Australia as a music duo, sole traders with an ABN, and we've always paid our own super. Because of the new payday super laws, we are now being pressured by our booking agency to form a two-person business partnership so they have no obligation to pay the extra 12% super. We sometimes hire other musicians, so we're obligated to pay their 12% super while we get zero. We'll be left earning less than everyone else while absorbing all the extra accounting work and costs. Enforcement from Ombudsman Union, etc., is non-existent for independent pub acts. If we refuse and remain sole traders, our gigs will dry up. And that's it for the career that we've spent our lifetime building. I'd love to know what you think of this and what's happening to everyday workers whose livelihoods are being squeezed by this new law. I absolutely did not think of this.
No, this is one of those unintended consequences from what seems to be a good idea. You know, the payday super laws are that instead of companies holding on to super payments for a quarter, I think you're able to do it, a month or a quarter.
Yeah.
They now have to pay super on the same day that they pay their workers, which seems rational and logical and good, except when you see Sylvia's example where you think perhaps there needs to be some sort of carve-out or, I don't know, wriggle room, I guess, Alan.
Yeah.
Yeah, it's really tough.
Yeah, no, I thought it was interesting. So do you think, we've got time for a couple more. What do you think? Your turn.
Yes, here's one from James. If Trump does his ubiquitous taco, did we just witness an Albanese limps back out of the tax changes we had to have? Or will this be another change? Because he never changes, my word is my bond. Did he just trump Chalmers after an extensive 2-day review? Please help me understand when Labor finally means what it says.
Oh, well, yeah, but politics, particularly with when you don't have control of the Senate, politics is a matter of negotiation, you know. You can say what you like. You've still got to get it legislated, don't you?
You've still got to get it legislated. And I think, to James's point, you've still got to face the electorate in a couple of years. I mean, I think there's a bit of calculation here, James, that Labor is hoping that everybody forgets by the time the next election rolls around and we're all, you know, got a million other things on our mind, that he was pretty explicit about not making changes to CGT and super prior to the last election. I think that is, it's a pretty cynical calculation to be honest.
Yeah.
But it is a political calculation nonetheless.
While we're on the subject of tacos, we probably should just mention we haven't talked about the Strait of Hormuz at all today, but the Strait of Hormuz is sort of open. There's more ships going through, but we're nowhere near back to, I think we're back to about 10% of what they were before the war began. I mean, it's going to take a while for things to go back to normal in the oil business and also the fertiliser business and gas and everything else that has to come out of the Persian Gulf.
Yeah, totally. And I think what's really interesting for me is that, you know, we're not seeing any let up in predictions around inflation. You know, we're not, although crude prices have dived, you know, I think we're back at 73 US a barrel or something like that, which is great. The physical price that people are paying are still quite high because, you know, as you said, Alan, it's going to take a while for all this to work its way through the system. So I think that's sort of really interesting that we're still expecting a wave of inflation to come in both Australia and the US, for example, and that will force rates higher in both places, according to most economists. So, you know, it's not really clear whether there's a deal in Iran or a half deal or a quarter deal or I don't know what it is anymore. But the actual price pressures aren't going away.
No, that's right. And also we don't know quite what the long-term future of the Strait of Hormuz and the Persian Gulf is. I mean, Iran has created the Persian Gulf Strait Authority, which it's not going to uncreate, and it's going to control traffic in the Strait of Hormuz. And they've imposed extra insurance on traffic on ships now, which seems to be some sort of de facto toll. And I think that there's a fair chance that we're going to have tolls
Yeah, I think that's right.
And that will be put onto the oil price in some way. I mean, I just think that that's going to add to inflation as well.
And I think that the problem that Trump has got and that the world has got now is that, this time last year, the closure of the Strait of Hormuz was considered by most commodities experts as one of those, it'll never happen things. Well, now it's happened. It's hard to imagine it doesn't happen again. I mean,
Yeah.
You imagine the midterm elections in November. Like, if you were the Iranians and you really wanted to mess with Trump's head, do you think you might announce a sudden closure of the Strait of Hormuz on October 28?
Yeah, that's right.
I mean, I just think...
And then there's the other straits, like the Strait of Malacca and the one that, I can't remember the name of it, the one out that gets ships out of the Red Sea. I mean, there's a few straits around the world that are choke points as well.
Yeah, he's really opened the door to something that's going to be...
And I think that in terms of the Strait of Hormuz, I think the key player is going to be Israel as to whether they accept the deal that ends up being signed, whatever shape it takes. I mean, we'll end up with another, one that was like the one that Obama signed in 2015, which Trump cancelled in 2018. And I just think that the key player in all of that, and from now on, is going to be Israel, whether they can accept the idea that Iran might end up with a nuclear weapon.
Yeah.
And that they'll continue to fund Hezbollah and the Houthis and all the rest of these proxy outfits.
Yeah.
That Israel will continue to want to snuff all that out, and in which case it probably doesn't in the end matter what America does. It'll just be with them. They will decide what happens to the Strait of Hormuz and therefore the oil market.
It's a messy situation. Alan, let's finish with one from David as school holidays looms. David says, do European summer holidays have any impact on domestic inflation? And if not, should we be encouraging cashed-up baby boomers to vacation abroad?
Couldn't agree more. Let's do it. I think baby boomers going for European holidays should definitely get a subsidy from the government, I think.
Yeah.
It would definitely control inflation. I'd be off to Italy or France, and I wouldn't be spending money here. I'd be driving up prices in Italy and France for sure.
Yeah. That's a great idea. That's some lateral
thinking. We love it.
We love it. That's right.
Thanks everyone for listening to today's episode of the Money Café with James Thomson, the Chanticleer. I'll be back next week with Stephen Main. Send in your question and we'll try very hard to answer it, even though there's so many we can't answer them all, to the Money Café at intelligentinvestor.com.au. Until next week, I'll be Alan Kohler, Editor-at-Large of Intelligent Investor and the finance presenter, columnist and podcast for the ABC.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
Talk to you soon.